You're going on a journey beyond sight and sound. You've entered the 7 Zone. And as your monitor of monetary mayhem on this journey through the dimension of imagination, I'm Matthew Mills. And this time we're taking a little look over the last quarter with an autumnal attribution analysis. Now, no reference to seasonal variation would be replete without mention of the weather, which constitutes a perennial conversational cornerstone for us, with the constant variations always commanding some kind of comment. Now, similarly, the reason I bring this up is that sentiment amongst investors has very much followed a distinctly seasonal pattern over the past quarter. The summer found investors in a pretty relaxed mood as markets pretty much accommodated the ignition of hostilities in Ukraine and took a more objective view of the energy supplies available from other corners of the world other than Russia. And this settled the initial anxiety at the energy shock into a slightly more sanguine disposition. Then, as long, lazy afternoons faded into the prospect of autumn, focus shifted to stubbornly entrenched inflation and what the Federal Reserve and other central banks might have to do by raising interest rates to bring this under control. As we go into the winter, escalating prices and rising interest rates really started to bite into investors' expectations of returns from their investments, and some fairly bitter economic headwinds and bleak expectations of recession have started to settle into markets. Now, much as the weather patterns have become increasingly erratic, the trajectory of economic events, at the best of times difficult to predict, as we've discussed several times during these lectures, these are also prone to sudden reversals, and that's certainly what we've seen over the last quarter. So, really, as we come into the summer, the effect of the war in Ukraine is to reduce energy supplies, and Putin's actions there have very much created inflationary pressure. Then, as we come into the autumn, central bankers have come back from holiday and realised that they needed to do something, and so started to apply the monetary brakes, so putting up interest rates to subdue the soaring cost of living. Now, then we come into pretty much the autumn, beginning of the winter, and the then British Chancellor, pictured here, pressed firmly on the fiscal accelerator, the spending accelerator of policy within government, and launched proposals for an immense and unfunded programme of public spending. Now, the impact of the Chancellor's statement at the time really can't be overstated. What actually happened was one of the world's largest economies, that's us, the UK, which has a reputation for fiscal prudence, supported by a spotless loan repayment record, actually appeared to be proposing a level of reckless extravagance that could actually, in worst case, destabilise the global financial system. As one might expect, market sentiment switched rapidly from sort of some fairly fatalistic expectations of a controlled slowdown in growth as interest rates went up. It went from this to a really alarmed kind of knee-jerk in the face of fairly calamitous and chaotic acceleration caused by the policy suggestions from number 11 Downing Street. The ensuing storm prompted extreme short-term volatility across all global asset markets, which is only now beginning to subside following some fairly prompt action by the central banks and the installation of a new Chancellor and fairly radical redirection in UK fiscal policy within a matter of days and weeks. Now, just before we go in, it's time for a quick attention break and another stunning statistic brought to you by SE7EN. Now, you probably have noticed, if you've read the papers, that there's a lot of narrative about being in a bear market. But you might be wondering, what on earth is a bear market anyway? And why is it called a bear market? Well, the idea is it's called a bear market because it's based upon the downward swipe of a bear's paw as it's attacking its prey, apparently, and driving down markets. So it's falling markets. Specifically, the technical definition, it's a falling market of more than 20%. And in case you're interested, there have been 10 bear markets since 1950. The longest lasted nearly 1,000 days, so nearly 3 years, and the shortest was just a little bit over a month. So, having established a backdrop of doom, gloom, uncertainty, and chaos, what does this actually mean for global investors? Well, first and foremost, specific economies suffered very, very significantly over the quarter. The UK being a case in point as a result of the policy announcements from number 11. Global investors, however, are not usually exposed overly to one particular region, which then mitigates the risk. So while the UK will have suffered tremendously, other parts of the world that one might be exposed to won't be, and that will dampen the losses you'd otherwise see if you were just investing in the UK. Equally, most investors will have broad diversification across a range of different assets. And that will also tend to mitigate volatility and the effect of a downturn. Specifically, if you have alternative investments, so-called negative beta strategies, which don't behave in the same way as the main stock markets, this will also tend to offset a downturn. Finally, when fund managers go and buy assets overseas, they buy them in different currencies. And one of the effects that we have seen is some foreign assets have actually improved in value simply because of a strengthening dollar. And that's also tended to dampen downturns a little bit compared to if one was exposed directly to the main markets in their native currency. Now, while the previous slide talked about some positives that tended to be supportive of a globally diversified portfolio, there were some elements which didn't go quite so well. So higher interest rates impacted both bond and stock markets. Bonds provide a fixed rate of return, and as interest rates from banks go up, these look less attractive, so their share price, their price tends to drop. Equally, as borrowing costs for companies go up, it tends to bite into the profits, and their dividend forecast and share price tends to drop as well. Specifically, one would tend to combine bonds and stocks in a portfolio because the behaviour doesn't tend to be very well correlated generally. But what we've seen over the last quarter is the effect, particularly of higher interest rates, has bitten into bonds and stocks, and they've become highly correlated, so we've lost the protective effect that would usually have. More broadly, a strengthening dollar tends to have a negative impact on an export-led current economy like the emerging markets, because it tends to put up the price of your goods you're trying to sell, so you tend to sell less and your profit forecasts tend to come down as well. Now, as both the weather and the markets become more turbulent, it would definitely be easy to sink into an equally dark mood. While the narrative around macroeconomic uncertainty implies a greater possibility of recession, it's certainly not inevitable though. And if the installation of a new Chancellor, followed by a new Prime Minister, serves to demonstrate anything, it's how narrative, investor sentiment and market trajectory can really change very, very quickly. Where we go from here, and there's no absolute certainty about that, and that's going to depend very much on the trajectory of price inflation and how aggressively the central banks feel they've got to raise interest rates to bring this under control. Now, probably in this respect, there's some reasons for very, very cautious optimism. Don't quote me on that one. But what we have seen is employment rates, consumer confidence, and housing market activity, certainly in the United States, the biggest single economy in the world, they've very much fallen over the past quarter. And these are all leading indicators which imply lower demand, lower spending, and reduced inflationary pressure. And actually, indeed, if you look at the trajectory of inflation in the US, the UK, and Europe, it shows some tentative signs of stabilising, if not yet falling. Really, energy prices, elevated by the constriction of supply from Russia, remain the critical component of inflation. Prompt action by European governments themselves, they're intimately dependent on supply from Russia. That's ensured that reserves are now approaching capacity. And the price shock that we saw when the Nord Stream gas supplies was turned off, that seems to have stabilised for now. The rate at which these reserves are depleted will dictate the time available for alternative sources of supply to be identified, and that can avert future shocks. But that's going to take time. And in the meantime, we've got a winter to contend with. A mild winter will bring relief to those facing rising heating bills, and the prospect of greatly improved economic backdrop to look forward to in the spring. Basically because we'll, with a mild winter, we'll be using less of our energy reserves, and that will feed forward into energy prices and inflation in the spring. So in this respect, having started with the fact that we always talk about the weather, and with the winter solstice still some weeks away, this sort of fairly anodyne conversation piece reflecting a curiously British preoccupation with weather now assumes fairly global significance. And really, it's macroeconomic effects, particularly through inflation, will depend upon us all keeping our fingers crossed and hoping for a mild winter and lower energy consumption. So there's a whistle-stop autumnal attribution analysis, but what have we learned? Well, first and foremost, one cannot insulate ourselves or our investments from global events when we have massive economic, geopolitical, seismic shifts going on. But diversification can reduce the risks and the impact of particular markets or particular events or changes in particular fundamentals. The other thing we've learned, and we've certainly been learning this over the last few weeks, is that market trajectory can change very suddenly, and that really negates the benefit, any benefits whatsoever that one might construe from timing, and that's virtually impossible. Has to be said as well, having gone through several of these kind of downturns and hopefully subsequent recovery, what we see is prolonged periods of downturn can end very, very quickly, and it's virtually impossible to time them, which really just implies staying firmly embedded and invested in the market. In this context, I think the final thing we're learning is that patience and discipline remain critical, and that we mustn't give in to any sense of reservation or anxiety and do anything rash with our investments. I almost don't need to say it because I do this at the end of every one of these lectures, but it's just to say that this video is intended to inform, to educate and to entertain, and most certainly does not represent advice in any way, shape or form. And with that said, again, we'll see you next time.